Guten Tag, Namaste, Ni hao, Bonjour, Kumusta ka, Konnichiwa, and welcome everybody to a short lecture on positive accounting theory. Positive accounting theory is a great little topic, quite easy to understand. The theories aren't very complicated and you can see them really playing out quite easily in the business environment and possibly within your own business experiences and in your own lives. So briefly, we're going to distinguish between the positive and normative theories, understand the roles of accounting from a positive perspective, and understand how particular accountants are expected to behave in line with the positive accounting theories. And we'll discuss some criticisms. So in preparation for your exams, important to understand what positive theories are, how they're different from normative theories, how useful they are in predicting behaviour, and also what the criticisms of the theories are. So what are positive theories again? They explain why something happens and predict why something happens. They don't actually give any managers or any accountants any instructions on what they should actually be doing, but they do predict in any given circumstance what choices an accountant may choose to make or what choices a manager might make about how they instruct their accountants to behave. So remember, there were two types of accounting theories. We've got the normative theories, which were prescriptive, which told accountants and managers what they should be doing. And they all come from the historical basis. Luca Pacioli, a normative theory, told accountants what they should do. Positive theories, again, tend to predict what we should be doing. So, what are they based on? What's the value assumption behind positive accounting theories? It's basically this. You always back self-interest. It's the one horse in the race that's always trying. What will we do? What will human beings do in any given circumstance? Back themselves. Do something that it is in their own self-interest. Why are you studying this course? Because you have an overwhelming interest in accounting theory? Perhaps. Perhaps not. Perhaps it's about you achieving what you want to achieve and your financial future. And that's the essence, that's the reason behind you studying this course. So when we're looking at the motivations or the assumptions on which we base the actions of managers under positive accounting theory, we're assuming that they're all acting to increase their own self-worth, their own selfish self-worth. Now, as you know, when you're working and in your working lives, not all of the decisions you make are in your own long or short-term self-interest. Some of them are, might be more noble, might be focused on other things, personal sense of achievement and that sort of thing. But these other aspirations are cast aside. It's all about everyone in it for the money. So in your highly focused reading of the textbook, you would have picked up in the positive accounting theory chapters of the textbook, PAT, positive accounting theory, written in one of two ways. Positive accounting theory written in lowercase letters, P, lowercase p, lowercase a, lowercase t, and also PAT, capital letters, positive accounting theory. This is a specific theory developed by Watson Zimmerman. Now, just to complicate things further, positive accounting theories are a school of theories that explain and predict. These two researchers here, Jerry Rotz and Ross Zimmerman, created a specific positive accounting theory, and they called it positive accounting theory, just to confuse things. When you're reading through your textbook, when you're reading an assignment or an examination paper, it's generally very clear whether they're talking about PAT, positive accounting theory, or the school of positive accounting theories altogether. What are the assumptions underlying PAT? Focuses on the relationships between various individuals and how accounting is used to assist in the functioning of these relationships. So what relationships do we have in businesses? The relationships between owners and managers and the firm's debt providers. Again, assumes all individuals' actions driven by self-interest, and individuals will act in an opportunistic manner to the extent that the actions will increase their wealth. It evolved from the efficient markets hypothesis. And we'll remember that as being when a company looked like they were doing well, had a good share price, had chances of making high levels of profit, they're more likely to attract resources in the market. What do we mean by resources? More likely to attract additional capital at a cheap price. So Ball and Brown in 1968 released a revolutionary paper crucial to the acceptance of the positive research paradigm. And what did they find out? When a company had an earnings announcement which was positive, their share price went up. Implicit in the share price, built into the share price, was an expectation of the future earnings of the company, potentially to a net present value type equation. If you're looking at it very scientifically, very mathematically, the earnings were impounded in the prospective share price, and share prices went up. If the firm was not expected to make much money or had negative announcements, the share price went down. So the Ball and Brown paper of 1968, revolutionary, but a very, very, very simple concept based on the efficient markets hypothesis, demand and supply, prices going up, prices going down, markets finding their natural equilibrium. Now, this was supported, why it was so revolutionary was it was supported by a lot of empirical evidence. So they looked at share prices, they looked at announcements, they crunched the numbers and came up with some very solid work on the topic. However, their work was unable to explain why particular accounting methods were selected. So again, the market forces, we're reminding, sits behind all of this as an assumption. The other thing that you'll have to understand is agency relationships. What are these? They're the contracts or the arrangements between one or more people to provide some service on their behalf, which involves delegating some decision-making authority to the agent. What does that mean? It just means that businesses have managers who are employed by owners. We can expect that an owner-manager in their own business, whatever the size, dedicates themselves fully to the best interests of the firm. But that is not the only management structure of a business where we have an owner-manager. Lots of businesses, and certainly the ones that we deal with in our studies and our investment, are owned by shareholders. And who manages them? Employed managers. The owners are shareholders, and the shareholders employ a board of directors and a manager to run the business on their behalf. The shareholders don't trust the managers to be acting solely in the interests of the firm all the time. So there's an agency relationship there. And we'll go on and talk about that a little bit more further. So because we can't control the manager completely as a shareholder, what do? We have to monitor them. So we have to bond them. How do we monitor them? We ask them to prepare financial reports. We have those financial reports audited. We bond them. What does bonding mean? We get ourselves in some contractual arrangement which aligns the expectations of the shareholders or the owner with the expectations of the manager. And there's costs involved in this. So what would the costs be? Preparing financial statements, giving some incentives to the manager which are linked to profitability or linked to levels of sales and things like that. But always in any sort of agency relationship, there's a residual loss. The managers aren't or can't be expected to act all the time in the interests of the firm. What might the residual loss be? The managers might act for their own interests. They might preference their firm of their son-in-law rather than the firm that's going to give them the best price for a supply contract. They might slack off. They might read the paper, surf the internet. They might be using company resources for their own private use. So there's always some level of residual loss there. So PAT, we can see here, has three underlying hypotheses: the bonus plan hypotheses, the debt hypotheses, and the political cost hypotheses. These three hypotheses go on to explain or predict what accounting method a manager might select. And we'll go through each of them in turn. The Bonus plan hypothesis. Managers of firms with bonus plans are more likely to use accounting methods that increase current period reported income. It's also called the management compensation hypothesis. And action increases the present value of bonuses paid to management. What does this mean? If you're a manager, show that you act in the best interests of the firm. The owner of the business enters into an arrangement with you and gives you a share of the profits. What are you likely to do as a manager? Select the accounting methods which best increase the profit of the firm. Pretty simple to understand. And those of you who have worked in So under the bonus plan hypothesis, how are managers rewarded? A fixed basis, salary is independent of performance. So what happens then? Under the bonus plan hypothesis, if you've got your manager on a fixed salary, they're not going to take great risks as they don't share in any potential gains. So potentially we have salary plus remuneration in part tied to perm performance, so a bonus scheme, and the bonuses can be tied to profits of the firm, sales of the firm, or returns on an asset. Where does this information come from? The accounting system. And who's potentially influencing the accounting system? The manager. If you were the manager, what would you do? You would make your chance of getting a large bonus as high as possible by making the firm as profitable as possible. Now, you could do this in one of two ways, working really hard, making some fantastic decisions, and boosting the performance of the firm. But you may also be tempted to making the firm's situation look better than it is, manipulating the accounting figures, or influencing them slightly by your choice of accounting method so that the firm looked quite profitable, choosing the accounting method that best served your own self-interest. Now, for those of you with a tax background, or all of us have to pay tax, what do we tend to do? Make profits look as small as possible. But under this scenario, to avoid taxation, but under this scenario, it's saying that no, the managers will select the methods that make the firm look as profitable as possible. Also, firms might reward their managers in line with the market price of the firm's shares. One of the other problems with contracting your managers into a bonus scheme is it may cause short-term rather than a long-term focus. May affect investment in positive net present value projects if returns are not expected to be consistent. So basically, the managers are potentially more likely to act in the short term, manipulate the figures. So this has been supported by empirical evidence. Again, something that we can quite easily understand. We see played out in our own working lives. We all know of sales managers that have smoothed the figures, manipulated the figures to make sure that they get the bonuses that they want for any particular period. So Healy found that managers adopting accounting methods to maximise a bonus if contract rewarded managers after a pre-specified level of earnings reached. If the income wasn't expected to reach the minimum, managers shifted earnings to a future period. So how would you do that in an accounting period? In an accounting sense, if you had a big contract signed that you had to write some invoices for, and you knew you weren't going to reach your bonus, if you're not going to reach the bonus, what do? You invoice that order in the next financial year. You don't do it on the 30th of June, you wait until the 1st of July. What happens then? That value of those big invoices or that large sale or big contract ends up going into the coming year's financial report and boosts the next year's profit. You know you're not going to make your bonus this year or this quarter or this period. You shift it into the next period. So in 87, Llewellyn, Loader and Martin found out that US managers approaching retirement are less likely to undertake research and development expenditure if it's based on accounting performance measures. It makes managers have a short-term focus. You're not, you're 64, you're retiring at 65. What real incentive is there for your company to spend $250 million on a research and development project, which may or may not come off? And even if it does come off, is not going to come off in the period of time where you're going to benefit from it financially. Remember, the assumption on which these positive accounting theories are based is on each individual manager is acting in their own self-interest, not in the interests of the firm. It might be a little bit short-term in its thinking, and it might be a little bit, like it might not hold true in every circumstance. You know, a lot of people don't only think about themselves, and there may be managers that would make an alternative decision. But on the basis of this research prepared in 1987, it was found that managers approaching retirement are less likely to invest money in these sorts of things. Market-based bonus schemes are also used by managers, and we'll go through and look at this BHP example coming up, which I showed to you at the residential school. So they're more likely in industries where the market value fluctuates greatly. The share price fluctuates greatly, because what are the owners wanting to reward? Not the market fluctuations, but the performance of the managers. They're not wanting to reward a high-tech boom or a mining boom and pay their managers an enormous sum of money just because the industry is booming. They're wanting to pay their managers or reward their managers for outperforming other managers in the same sector. So you might want to pause my voice here and take a little bit of time to flick through these next two slides slowly and have a look at the factors that BHP are taking into account. They're obviously identified, probably not explicitly, they probably haven't read the book on positive accounting theory, but they know that these things hold true. They know that managers work harder if they have, as they call it, skin in the game. Their bonuses are linked to the performance of the firm. They also make their managers own shares in the firm, huge amounts of shares, okay, linked to their total earnings, and they make them hold on to those shares for a long period of time. You can see here they look at linking their bonus scheme to a rolling 5-year total shareholder return figure. What do they do? What is it made up of? Share price movement plus dividends. So they're linking the results of their manager quite cleverly to the rewards that the owners get. So you would think then, on a longer term basis, those managers are likely to act in the interests of the owners. They also make them owners of the firm by making them buy that many shares, huge amounts of money there. You might want to pause me again and have another read through the second half of this article. Not used across all of every company, relevant only for some companies. QBE is the only other company in Australia's top 30 listed companies to measure over a 5-year period. So, choice of accounting versus market-based bonus schemes. It's more likely to be based on accounting earnings, where share returns are relatively more sensitive to general market movements, where earnings have a high association with firm-specific movements in the firm's share value. Accounting numbers can be useful when rewards are based on divisional or subunit performance. There you're wanting to identify the specific achievements of individual managers of a section, the overall share price not particularly relevant to those or the activities of those individual managers. At that lower level, better to link it to accounting numbers. So what have the researchers found? Offering managers equity-based incentives increase the manager's likelihood to disclose information. So what did we learn in our earlier topics? If a firm goes out to the marketplace, announces that it's going to make a good profit this year, the share price goes up. If it says it's going to make not so good a profit, the share price goes down, but not to the same extent as if they made no declaration at all. So if managers are linked this way to the bonus schemes of the firm, to the share price of the firm, they're more likely to make regular, timely and accurate announcements because they want that share price to stay up there. They've potentially got shares themselves. They've also got their own remuneration package linked to the value of the shares. So that is the bonus plan hypothesis. What's our next one? The political cost hypothesis. What does political cost hypothesis come into? What's the main thing that sits beside that? Size is a proxy variable for political attention. What does this mean? People look at really big things, don't they? If someone's making a lot of money, they're more likely to attract political attention. What does that political attention result in? Attention from government, lobby groups, collectives of individuals. It may result in increased taxes, increased wage claims, product boycotts. We've seen the mining tax in Australia. It was called what? A super profits tax. What are firms likely to do in these situations? Adopt accounting methods to reduce profits to lower political scrutiny. Another example we can see of political costs, or this assumption of size being a proxy variable for political attention, is the Shell article that I think I brought to your attention a little while back. Shell made $60 billion over 3 years and paid not a cent in Australian company tax. They had a sophisticated transfer pricing scheme, which meant that most of their profits were made by an offshore Singaporean company, and the Australian government didn't receive any taxation. What happened? We've now got a Senate inquiry. What could potentially happen from that? Increased taxes, a change in regulation, more public and political scrutiny on that firm. What's that firm likely to do? Adopt accounting methods to reduce profits, potentially to lower political scrutiny. So when we talk about political scrutiny, it's not just the attention of governments, it's also political action of individuals. So we know as individuals, there's not much we can do, but we form interest groups. What happens then? The information costs are shared. There's an ability to investigate government. Because we're larger as an interest group, we have a lot more credibility. We don't look like one individual nutter. We're a group of organised nutters. Given self-interest, representatives of interest groups are predicted to maximise their own welfare as constituents have limited motivation or means to be fully informed. What does that mean? The lobby groups themselves become a political power, and they're potentially acting in their own interests as well. Actions of politicians. Politicians know that highly profitable companies are often unpopular with members of constituencies, and politicians can win votes by taking action against the companies. And certain sides of politics, certain political parties might be more prevalent along this sort of theory as well. They may rely on reports of high profits to justify action. So you can see politicians coming out highly critical of companies which are making high profits and then sending many jobs overseas and offshore. So that was the political cost hypothesis. The main things to remember: size is a proxy variable for political attention. People look at big things, big elephants, don't they? The next hypothesis, debt hypothesis. The higher a firm's debt equity ratio, the more likely managers use accounting methods and increase income. So what happens when we've got debt? When a company's got a debt contract with a bank or with another private individual, they want to make sure that the firm doesn't overcommit themselves to debt, to paying high dividends, all of these sorts of things. They contract with the firm's managers to keep the performance of the firm within a given level. So the agency costs of debt, remember we were talking about agency costs before, residual costs, those sorts of things. What are the costs associated with these contractual arrangements? If a firm pays excessive dividends, it leaves fewer assets to service debt. Organisations can also take on additional debt, with new debt holders competing with the original debt holders for repayment. An investment in high-risk project may not be as beneficial to debt holders as they have a fixed claim. Now, this is something that we can see playing out quite clearly in the management of our own business. We're a privately owned business and we use debt as our major source of capital for expansion and working capital. What do our bank require of us? Every year we prepare for them a budget. And what do we put in the budget? Obviously all of the operating costs for the business and also our drawings, our dividends effectively, the money that we take out of the business for our living expenses, and so on. What do they ask us to do? Prepare this budget. We know if we show a budget with excessive living expenses, excessive drawings, excessive dividends, they're not going to be happy with it. Why? Because it leaves us with fewer dollars to pay their interest bill back. So they basically contract us into this budget that we have prepared. They say we will only lend you up to this level, which only gives us enough for a certain amount of living expenses and dividend expenses. We can't go out and buy a new Mercedes. They want to see that capital remaining within the business for its future expansion and for the payment of their interest and to secure their debt. They contract us into not taking on additional debt. So they say if you are to enter into any other debt contracts with any other banks, finance companies or businesses, you have to make us aware of that. They don't want anyone competing with their interest bill. They're also not interested, potentially, in high-risk projects. So we were looking at expanding our business quite significantly a number of years back. The bank went behind it. Why? Because it was one of those projects and the situation we were in at the time, which was a sink or swim. We were definitely thinking we were going to swim. We were going to make it a successful project, and we had no doubts that that would have happened. But the bank potentially stood to lose a lot of money out of it. And they weren't going to gain anything more out of it. They were still going to get just their solid interest coming in. Even though we had gone to we might go to such a greater level of debt, greater level of risk personally, they were still only going to get the interest at the time, which was probably about between 6 and 8%, I think. So they weren't really interested in jeopardizing the whole operation for the chance for expansion. So you can see the situation that a firm which relies on debt rather than shareholders' capital might be in. How does it change the actions of the manager? What do we do? Well, what do we do? I'll get back to my other slide. We're more likely to use accounting methods that increase reported income. We're potentially also likely to put things that are off balance sheet that the banks might not be as aware of. So we might negotiate better terms with our suppliers rather than extending our overdraft. So these are the sorts of things you could expect on the under the debt hypothesis that a business owner might choose to do. So Cotter in 1998 found that leverage covenants frequently used in bank loan agreements, bank loan contracts, they're contracted to have their debt and equity ratio at a particular level. Prior charge covenants are typically included in term loan agreements of larger firms, requiring the bank to be paid back first. Debt to assets, interest coverage and current ratio clauses are frequently in use. And interest coverage required to be between 1.5 and 4 times the interest bill. So what's the incentive to managers to manipulate the numbers? Ex post, so that means after the contract has been written, the incentive to manipulate numbers increases as the debt covenant constraints approach violation. So a firm, closer it is to breaching its debt covenant, closer it is to exceeding its overdraft, or closer it is to having its debt reach a level which breaches the earlier reported ratios, what are they likely to do? Manipulate accounting accruals in the years before and the years after the violation. It's too costly to stipulate all acceptable accounting methods in a contract, so managers always have some discretionary ability. The other thing to remember here is the relationship between risk and interest rates. So businesses that are higher in their level of risk are more likely to have to pay a higher interest rate. So there is incentive there for managers to potentially manipulate the numbers to make their business look less risky, to negotiate a lower interest rate. So what were the three hypotheses again? The bonus plan hypotheses, the debt hypotheses, and the political cost hypotheses. So as an example, if a manager had a choice to expense or capitalise an item, what decision would be made under each hypothesis? So you could this is a question just for yourself to have a think about. If you had a choice to expense or capitalise an item, so you were potentially looking at purchasing a piece of machinery, you could rent it, potentially at a higher cost, or you could capitalise it, so you could purchase it potentially outright. What decision would you make if your firm was enormous and you were subject to some political scrutiny? What would have the biggest impact on your profit? If you wanted to make your bonus, what sort of decision would you make? If you were looking at breaching your debt hypothesis, breaching your debt contract with your bank, getting your bank manager getting into a bit of trouble with your bank manager because of your level of debt, what would you be more likely to do? So have a think about that one. I've got a few more slides here. I'm not going to read them out to you. You can just pause the recording and have a read of them as you go through. But just make sure that you understand those two issues of performance pricing and the role of external auditors. Criticisms of PAT, important to know, doesn't provide any prescription, so it doesn't guide a manager or an owner as to which accounting method they should use. It's not as value-free as it asserts because it assumes that everyone is driven by self-interest, which is quite a negative and simplistic perspective of humankind. The issues haven't shown a great deal of development, and you'll see that by looking at the dates the research has been published. Also, in undertaking large-scale empirical research, what does that mean? Looking at those share price results over a huge amount of companies, over a huge range of share capital markets, the researchers ignore organisational specific relationships. So they might be more important into driving the behaviour of individual managers and owners, their relationships that they have together, the relationships that they might have politically in a country, or the relationship they might have with their debt holders. They might drive the actions of the manager more than the empirical results or the share price reactions to different earnings announcements. So those organisational specific things might have more of a role to play. So I hope that was useful and you now have a better understanding of positive accounting theory than you did before you started reading. Have a look back through the slides. There's some other cross-references there to the Deegan text. So if there's something that you don't understand or you'd like to know a little bit more about, useful to read up on it a little bit more. Thank you.